Good afternoon. My name is Patrycja Maksymowicz, and I'm the founder and director of Open Solutions Global. A warm welcome to all of you at the SmartMoneyMatch Summit, and thank you for joining me. Open Solutions Global is an independent consulting firm focused on generating growth and helping companies with strategic market access and market development. Over the last few years, we have built a portfolio of projects and a team with deep experience in working for both global and regional companies. Our clients vary from startups to scale-ups. My session today is investment due diligence, and I'm going to look at startup investment in particular, and both from the investor and the business seeking funding side. At Open Solutions Global, we believe that the challenge with investment is twofold. For startups, it's crucial to obtain the investment in a quick and efficient way, and for the investor, assurance and minimizing the investment risk are crucial. Our experience so far shows that most startups and even more mature companies are not necessarily often able to see the business through the eyes of the investor. While some investors sometimes commit to a deal before the comprehensive due diligence has been done, that comprehensive process exposes issues or things that companies seeking investment fail to disclose. So in such cases, deals often fall apart. I'll give a few examples of such reasons later in my talk. So what is due diligence? It's basically an investigation of a potential investment to confirm all the facts and to ensure that the investment will meet the investor's needs. The process helps them to determine if it's their initial decision to provide the funding is based on accurate information and will bear fruit. As such, investors check your finances, your company structure, legal documents, key personnel, employment contracts, and so on and so forth. The main categories that we identified is the commercial, financial, technical. So for example, if your business is a software or tech service, they will provide an IT due diligence on technology. They may call your clients to make sure that they are happy with your product. Legal, and in some cases, some investors want also something like an impact due diligence. So what is the sustainable impact of your venture on the local ecosystem or the wider ecosystem? And of course, the approach you take will slightly differ depending on whether you're investing in a startup or whether you're looking to invest in a more mature business. You will need to determine what type of experts you need within those areas like commercial, financial, technical, legal, maybe sustainability, due diligence. I think the process is very often seen as something negative, and that's not. It's actually a beneficial process for both the business seeking funding and the investor. So why due diligence? And why do we spend so much time and energy and money? Why do we invest so much into understanding the business? I think the biggest takeaway is that it will expose the main risks and strengths of your company. So not to focus only on negatives you find, but also the strengths to get a better understanding of them. Some things to consider is how's the company organized? Does the structure foster growth? Are revenues realistic? What is the current and potential market size? They will conduct competitive analysis. They may speak to your clients. So there are a number of points that will cover. None of the startups is perfect in all areas. None of the business, even more mature, is perfect in all areas. So if there is a special aspect of your company that really stands out, make sure your investors have a good understanding of that. Whether you're investing in a startup or acquiring business through sale or merger or another method, due diligence checklist is something that's very useful. It's an organized way to analyze the company. And by following that checklist, you can learn about the company's assets, liabilities, contracts, and potential problems that might be awaiting. To make sure you don't overlook anything, Having a due diligence checklist allows you to see what obligations and liabilities issues are there. This information will help you to analyze and decide whether it's a good investment and whether that company is good for business. It also provides a way to measure the length and cost of integration and potential revenue. So companies seeking funding might also want to have such checklists. So it's not just for the investors, but it's also for the companies seeking funding to analyze that they do have everything that they will be asked for. What to have on your due diligence checklist? I'd be happy to provide one if anyone wants to contact me later on. Some of the main points will include the organization and the standing of the company, with financial information, of course, so looking at the financial numbers related to the company you're researching. It may be best to start with revenue, profit, and margin trends. Revenue streams, including pricing. Any potential antitrust issues or regulatory issues. If there is tech within the business, then a list of software used by the company, a list of licenses, the current system usage and age of that equipment, outsourcing agreements with the IT companies, the disaster recovery plan. What happens if the system crashes? Product and services, so list of products and services offered, services in development, and a summary of complaints, feedback from clients. So the list can go on. And one of the most important points here is also intellectual property. So a list of foreign and domestic applications, copyrights, a list of trademarks, and it's extremely important to actually have that done. It's one of the first questions they will ask for. And then the team. So what's company management and ownership? Is it still run by its founders? Look at the consolidated bios of the managers to see what kind of experience they have. Look if the founders and managers hold a high proportion of shares. But it's not just checking the boxes in between the deal and negotiations and signing. Once you gather all the information from the checklist, you can brainstorm worst and best case scenarios. It's useful to mitigate any incomplete information that is missing. So actually ask about that. Picture what the company will look like once you invest, and then prepare for the post-close. Analyzing thoroughly to see the potential for profit margins, operational efficiency upgrades, market competition and market review, monitoring trends in market, and examining the impact of new technology. A common problem in due diligence is very often tax liabilities, another one outstanding director loans, poor attitude to managing funding, and IP protection, which I've already mentioned. So what are the warning signs and common pitfalls? There may be a co-founder that went separate ways at an early stage had they signed a general release. So that's very important. All the employment agreements and terms and conditions, and are your employees actually what you're saying, your employees, or are they contractors? Are they part-time or full-time? If you've got a product, what's the traction? And if there is a traction, they will definitely be keen to speak to customers. Again, talking about the product, they might want, if it's a technology, they might want to do the tech review. They will ask you about an IP and patents. One of the things that is really important to have is the cap table. And whether you're seeking investment or not yet, I would advise to have that from the very, very early stage, very early on, and keeping track of what happens to, to the ownership. So the table basically provides the analysis of a company's percentage ownership equity in each round of investment. Speaking in practical terms, say you give the big chunk of the company to a co-founder or someone at an early stage, at a seed stage, you give away, I don't know, 60 or 70%, and they leave. Now, this might cause problems later on when you want to raise more capital. So I would suggest to have a long list of potential investors to start with, and then shortlist the ones that you think meet your criteria or would be the best fit. Once you have that, and once you start the dating process, do your research, talk to other founders, ask them questions about things. So what happened when things went wrong? Because there will always be things that go wrong. The most important thing is to be organized and to make sure that the whole process of the due diligence is as smooth as possible. And you, as a company seeking funding, can actually make it much more easy and speedy, because the process is not short. You can provide the insight in an organized way. The easy way to do that is to have that have the files in folder, have all the documents in one place, ideally in different sections or in different folders for all the areas that we are going to look at. Now, I would suggest having them in a digital format, and that's probably what you have. So having that digital data room is extremely important. Can be even at the early stage, can be Google Drive, as long as it's safe, as long as it's well organized and updated. So as even if the process starts and you get some documents that you think might be of value, adding those documents and sharing them is useful. Another takeaway is to show that you understand the process and you know what to expect, and you work alongside the people that do the due diligence, investors, and whoever you're, all the stakeholders. Be honest and transparent. I think very often, I mean, I haven't seen a company that was 100% ideal. Whether it's a startup or a more mature business, there will always be skeletons in a closet, but don't keep them there. So I would suggest to let them out as early as possible. Can due diligence kill the deal? Well, there will always be holes in a company, and no business is ideal. So in order for the deal to not go through, if you've gone so far as the due diligence process and if they engage with you, it's usually a sign that they've initially screened your company and you've gone through that successfully. So there is that intention to put the money on the table. However, some deals do not go through, and it's usually because of some information that has not been disclosed at that due diligence phase. And you know, it's you can keep those skeletons in the closet, but they will fall out at some stage, and then it's usually much more difficult to explain later on. So it costs the investor the time and money, and they're typically committed to put that money on the table. But working with them and being transparent and open will help. It's a long process. It's not short, and making it as easy as possible and being well prepared is, so I think it's crucial. It's a priority and can help. Looking at the number of companies that apply and go through the screening process. So let's say a couple of thousand goes through the screening process. Around 5 to 10% of those companies would go through that process successfully into that next level where the due diligence is done. And then around 50%, half of them, would finalize that successfully. So as you can see, it's quite narrow. That funnel is quite narrow, and there is quite a lot of filtering through. Thank you very much for your time. If you'd like to learn more or would like to receive that due diligence checklist, I'll be happy to send it to you. Just contact me on at my email, acc@opensources-london.co.uk. You can find me through the website or connect with me via SmartMoneyMatch platform. Thank you very much.